have the profitability, we ought to have a hurdle rate below which we should not go because or lest we incur losses on the investment what we make. Is hurdle rate just sufficient? Sometimes projects may have to be taken up even if there is no hurdle rate, or when we understand another rate. What is that? The opportunity cost of capital. Hurdle rate is a rate which computes the cost of capital and below which it is not viable for a project, for an asset, for a company to function. Opportunity cost is without doing anything, if your capital is invested or is parked, what you earn is the opportunity cost. That's the difference between these two. Any further discussion or query on difference between these two can be taken up towards the end. There could be few, we will definitely take up towards the end. It is not just this leverage, scalability, hurdle rate, opportunity cost. There is something called financing breakpoints, beyond which we may not be able to mobilize, beyond which we may mobilize, but it is not viable, beyond which we may mobilize, it may be viable, but it cannot sustain. It is those which we fix as pegs on financing program, which we call financing breakpoints. It is the CFO who knows, who only knows what is a breakpoint. Management doesn't know, department doesn't know, banks also may not clearly know what's a breakpoint of their borrower clients. It is the CFO who can see the company and the promoters completely naked with his pure eyes, understand what is the real strength, understand where does a breakpoint for this company exist. Therefore, not to cross that breakpoint on our financial books. When we know what is a breakpoint, we get to know about the beautiful optimal capital structure, which itself is a safeguard, which is a good platform for the company, which shelters, safeguards, which saves the company to remain solvent and afloat in the market. Arrive at the optimal capital structures, we require again the weighted average cost of WACC at our cost of capital ratio. That we complete by having proportion of retail equity as a formula. All of this will build value into the business, value for the business, value for the company. Therefore, each of the concerns of CFO, each of these 8 key concerns that we discussed as a broad concerns, result in the value of the business, value for the business. Is the value maximization what each of us as a finance leader has to achieve as a part of our responsibility. Everyone has a dashboard. Our colleagues like Chief Tax Officer, Chief Marketing Officer, Chief HRO, CEO, other CXO colleagues do have their dashboards. Do we have a dashboard? Of course, yes. Do we have a dashboard on cost of capital alone? Yes, of course. It could be a sub dashboard or a main dashboard, depending upon the nature, gravity of our function and our breadth of the activity. But the dashboard can broadly have 4 things. First, on the debt part, current cost of debt, and if you have to borrow more, what's the marginal cost of debt? It definitely increases or could stay flat. Is it increasing or does it stay flat? If it increases, what's the marginal cost of incremental debt? That part. And what's the tax shield we enjoy on the debt portion by virtue of the tax applicability for us? Should there be a change in the tax rate? What's a tax shield change? Instead of sticking to a theoretical formula, we need to revise our tax shield computations so that we take realistic decisions at each point of time as and when there is a tax rate change. And of course, the market value leverage and the target leverage. What's the market value leverage? What's our target leverage? Market may allow you to have a leverage at X scale. Can we afford that? Do we need more? Do we need less? And lower than that should be our target leverage, the debt program which we include in our overall financing program. And then the credit spread on the risk free to our cost of debt, which is with the premium of the risk pertaining to our company. What maturity profile can we afford to take? A company or a business which is into day to day food item selling cannot afford to take a 50-year loan. An airport project which requires at least 8 to 9 years to break even cannot afford to take a 1 year loan. So the airport project would require 15-year loan, 20-year loan, and the quick service restaurant, which has its revenues coming on a daily basis, may require 1 year loan, or half-year loan, or medium-term loan between 1 to 3 years. Look, if a shift of these things happen, the maturity profiles shift and the projects would collapse. And of course, the business will become insolvent. Apart from these things, what is the floating rate exposure we have in our dashboard, on our dashboard? The floating rate exposure and the current floating rate of the interest applicable to us, be it repo linked, be it MCR linked, or be it any other peg linked, unless we have this variable also, those and this variable also on our dashboards, we will not have inputs for our understanding and inputs for our decision making. It is that inputs and information what we need with the knowledge on cost of capital and financing programs, which can be put onto our dashboard. They will allow us to function like a real informed CFO, and our decision, our input to our colleague CXOs, be it CEO, Chief Tax Officer, Chief HRO, Chief Marketing Officer, Chief Strategic Officer, and the like. Their decisions are dependent on inputs from us as finance leaders. Therefore, on the debt part, these are the variables which have to be captured and at all times displayed to us on our dashboard. On the equity side, the cost of equity, the beta, what is applicable to us, beta does change dynamically. Cost of equity, therefore, changes dynamically. And equity risk premium, of course, changes as per the change in the risk premium of the country, of the sector, of our company, and sometimes of the challenges we are facing because of any reasons. Unless our dashboard also captures the cost of equity in its entirety, we may not be able to understand what is the leverage that we can take on this equity base of our business. Coming to the cost of capital of business units, we cannot have one cost of capital for the whole of the company. Yes, we do need to have, we will have, but then it is not sufficient to have cost of capital at the headline itself. Cost of capital, specifically the weighted average cost of capital, needs to be computed at each business unit level, at each SBU level, at each subsidiary level, sometimes if required, at each location level, at each projects level. Risk premium varies from India to Afghanistan. It can't be the same risk premium. In a Nordic country like Denmark, Sweden, you don't add risk premium only. You may put minus risk premium or just 0.001 as risk premium. Whereas in India, you would put a risk premium of 3.5. In Argentina, you would put a risk premium of 20%. In Afghanistan, you would put a risk premium of 30%, which means the WACC, WACC, does change from location to location, and it does change from business to business. FMCG business will have lower cost of capital, and solar panel, solar power business will have higher cost of capital, and the most riskiest business, which is oil, can have even higher cost of capital. Depending upon each of these business natures, those business units or the subsidiaries will carry their specific WACC. Similarly, certain projects could have fathering the shelter from the government, or could have tax shelters, or could have lower cost of capital funding from the bankers or the lenders, and could have got a sovereign support by virtue of power purchase agreement, offtake agreement, or take or pay agreement, etc., and so on. When such kind of rigid, solid support system is in place, certain major projects could command far lower cost of capital. At the same time, projects which are exposed to the market forces, which do not have such kind of shelter from the government, can stand priced at a higher WACC, which is as per the market risk. It is these nuances which we have to factor and compute WACC for separately for each of these aspects than having one WACC only at the company level. The spread between return on invested capital and WACC is the profitability, the profit margin, what your entity enjoys. It is this spread what has to be always visible to you as the financial leader, and to have your broad smile before you comb your brad or your crop. It is this spread which gives you peace of mind for the day's sleep. That spread and the WACC should have reference to your hurdle rate. Therefore, how many of your projects are above the hurdle rate, how many are below, can be seen from your dashboard to be completely relaxed. Why all of these things? Because business is not static, it is not a stalemate, it is dynamic. And for your new projects, you require more funding. There could be rolling over, there could be a cycle, but then as business continues to be a going concern, it requires higher degree of capital, be it equity, be it debt. And mostly the funding capacity is tapped from the debt source. Therefore, it is debt what you are more concerned to raise funds. And that debt is dependent upon the WACC of your business. Therefore, with this brief context and discussion, we are proceeding now to discuss the broad four aspects. WACC, weighted average cost of capital. Every business has equity and debt as the broad two categories of capital sources. Equity is the most dearest thing. It has its proportionate cost. Debt is a darling of the business. Therefore, it has its own proportionate cost. Proportion of equity in the business into cost of equity plus proportion of debt in the business into cost of debt gives you the weighted average cost of capital. Headline, the chairman's input is what is our WACC. Headline, your chief tax officer or your CMO would like to only understand what is your cost of capital. Although I am detouring, one of the days in one of my previous companies, chairman quickly asked me over telephone, speaking about a very popular refrigerator company, air conditioning company. The Dr. Kishore, is it possible that they are claiming their cost of capital as 5%? Is it possible? Spat, I replied, impossible, sir. It can't be there in India. It has to be at least 8 and above. Quite some time back, couple of years back. Chairman said, okay, I think this person is telling me, trying to misguide me. Thank you. And then he put off. His discussion with the chairman of that big air conditioning company went on. And for some reason, sixth sense, vision lines struck my mind, and I opened that listed company's balance sheet. I was surprised to see, because that company is having most of its funds rotated, rolled over, mobilized and recycled by way of buyer's credit and mostly by way of commercial paper, their cost of capital truly was about 4.64. I was surprised. Although I gave a rant in the evening, but then that meeting went with a bad input. That has given me enormous learning, because I never knew that a company of that size can have that kind of cost of capital. Being present in India, with the sovereign credit rating of India being BBB plus, applicable to all the companies within India, it is otherwise not possible to have a cost of capital at lower than 8, which is the bank's MCLR or benchmark prime lending rate, BPLR those days. But it is possible with a structuring. That is what we learned. How do we ensure, by having a pecking order, how do we ensure that the overall weighted average cost of capital can be lower? It is that what we learn in detail in the days to come or in our later course of discussions. WACC, cost of capital, is not project's hurdle rate. It is at the company, all the debt into the company, all the equity into the company, the portion of equity and debt carrying their respective costs will be summed up, and therefore we have CACC at the company level for broad line, headline discussion understanding. However, WACC at the company level is not the same for all projects. As we discussed a while before, there could be a project which is absolutely safe, ought to be given the benefit of zero risk. There is a project which is relatively unsafe but broadly safe, ought to be given a risk-free rate equivalent to soaring rate, the T-bill rate. And a project which is exposed to market requires complete risk-free rate assumption, full risk-free rate assumption, not discounted, not subsidized, and thereon to be added with the risk premium. So each project can have a WACC. The expertise of a finance person depends on understanding this insight and computing WACC for each of the projects and then summing them up to arrive at the overall cost of capital for the company. Generally, we don't do that because we don't have time. Sometimes we have insight, but we don't have inputs. Therefore, smartness of a finance leader is also on collecting the inputs timely and putting all the variables into our format and compute WACC for the company, WACC for each of the projects, and suggest your CEO, CTO, chairman, and other CXO colleagues that this project may please be carefully handled because of its hurdle rate equivalence, hurdle rate subpar. This project, if possible, should be sold off, albeit at a loss, because we can minimize the loss by getting rid of this loss-making project. Those kind of strategic decisions, those kind of insightful inputs can go from your pen, from your message, from your word, only when we have this computation of WACC at the company level and at each of the critical projects level also. We tend to use our book value weights. It's not wrong, but it is incomplete. We ought to take the applicable right market value weight and compute WACC, which is the true cost of capital. Why? We'll discuss a while later. At all times, it is the marginal cost of capital what has to be seen, known, because your equity into the business, your debt already mobilized, carry their respective costs. Also, although the cost of debt of a contracted debt program, it could be bank loan, debt program, bond program, debenture program, or any other MTNs, etc., commercial paper, etc. They carry that coupon until their redemption, until their liquidation, until their repayment. Equity cost of capital keeps fluctuating. Every dollar, every rupee into your business changes the cost of capital of your company. Equity cost of capital of your company, which we don't understand. Therefore, it is not static WACC. It is the marginal cost of capital which is key, and mostly debt. And mostly debt, because debt has marginal cost of capital increasing higher than that of equity. Equity has a bit of resilience, and the cost of equity will not rise too high as much as cost of debt will rise whenever there is a change in the financing structure of a company. These are two deeper thoughts, dear friends. I'm sure all of you are refreshing your experiences of financing programs, equity mobilization programs, debt mobilization programs, but we can definitely take some queries towards the end, should there be any, or we can note some views from our valued views from our learned professionals. Now, debt. Debt is capital which has to be repaid, unlike equity. Debt carries a fixed coupon. Debt carries servicing obligation. Debt also carries covenants. That is debt. And debt can be mobilized only when there is equity. 1 rupee equity can get you some debt. Zero equity cannot get you debt. There cannot be a zero equity company. I repeat, there cannot be a zero equity company. However, there are companies with negative shareholders' net worth. There are successful global MNCs, very big companies, doing extremely well for decades, still continuing to do well with huge reserves, negative shareholders' capital, funded by debt, and completely safe, doing smooth. That is another topic for another day. But for now, for a normal company, there cannot be debt unless there is equity. When we compute the cost of debt, it is customary that we give adjustment on the tax part to the debt, because interest cost what we pay on debt is tax admissible. However, the tax shield would vary, and the tax shield is available only when we have profits to pay tax. Otherwise, no. This truth, this fact ought to be factored when we compute the cost of debt. Changes in the tax shield, as we discussed in the first, second slides, also have to be factored into our revisions of each of the cost of debts. In cost of debt, you have to price the covenants also, which we generally tend to miss out. What are these covenants? One of the covenant of your debt sanction may stipulate that you have to park 12 months equivalent debt service reserve account. 12 months equivalent debt service reserve account will reduce your cash flow flexibility, your liquidity. That FD, fixed deposit, carries 3.5%, 4%, 5%, whereas your debt is 8%, which means you are losing out around 3.5% to 5% on this locked up additional cash flow, which is because of additional covenant, additional clause in the debt sanction. Similarly, there could be a clause which says you cannot distribute dividends to your equity holders or to your preference shareholders for next 3 years, or until your cash reserves are these, or your profitability is this. Such covenants in the debt contract, what we have, will stifle the flexibility of your preference dividend payment, equity dividend payment, and those respective agreements can carry, may have and carry and impose some additional penalties on the company when you remunerate them in the subsequent periods. Where does this additional cost get factored? Who does these costs pay? All company, which means the overall profitability reduces, because the WACC what we computed wasn't realistic, was theoretical, was good on balance sheet top of the page, but when you look at the agreement and the covenants, it is not truthful. So these things have to be factored in. Debt is cheap. Of course, debt is cheap. That's why debt is darling. Equity is expensive, riskier, residual. While debt is cheap and is the darling, there is a limit beyond which debt can be cheaper. After a threshold of your financing break points, which we referred in our initial discussion, after the financing break point of debt, debt becomes expensive, and that expensive factor can become prohibitively expensive. And after a higher break point, debt could become unavailable for the company. Unavailable. No more debt for this company. It's already touched its high level financing break point on debt. It could be the case. When you look at some of the insolvency companies, and when you backwork their balance sheets, tear them apart and look at them, you will understand that there were financing breakpoints which are flags, red flags, real flags, visible there that we did not see, could not see, because the situation did not warrant, or we didn't have the suspicion. But in hindsight, when you retrospect, you can easily find out all of these red flags clearly, which could throw lessons for us for the future transactions. Now we have to go to equity, because we said debt is cheaper than equity generally, other than in such cases. Then what is equity? Equity is the most dearest source of capital. Debt is the most darling of capital. Equity is the most dearest source of capital. Equity is dearest for other reason, that it is the most expensive source of capital. Companies start with equity, but as they grow, as they scale up, they tend to avoid mobilizing equity. They tend to mobilize debt only, because not because equity doesn't have cost of capital unless you pay dividend. Debt has cost of capital because you pay interest. It's not that. That is not the equation what we traditionally understood. Those equations what we were taught during our graduation days were all wrong. Equity equity has the highest cost of capital, most expensive source of capital. Why? Because every additional rupee into the business increases the cost of equity, although slightly lower than rest related debt cost. On the overall thing, it is the equity holders who have to be remunerated, and equity also has the control aspect for the equity holders. And equity not only dilutes the control, but it burdens the company in maintaining the earnings per share and dividend per share forever, eternally. Because of these reasons, equity is always dearest. It's residual source of capital, most expensive. For this reason alone, and not for only control reason, for this reason alone, companies tend to mobilize equity towards the end when there is no other source, when there is no other leeway. And realistically, when there is no other leeway, whatever comes in the form of equity is a sharp money. It's not sharp money, it is not investors' money. That comes with as many clauses as possible and will eat into the company's profitability in the periods to come. The cost of equity is opportunity cost. Is debt not opportunity cost? It is. But then, as you understood by now, and as you are also aware of, debt will not come into the business unless you need it, unless you have an opportunity, unless you have a project. Equity is sitting in the company. Therefore, equity has a cost, opportunity cost. When you don't mobilize debt, there is no debt, there is no opportunity cost. But when you have equity in your company, which need not be mobilized afresh, additionally, it has a cost. And what about WACC? Yes, WACC also has opportunity cost. Equity also has an opportunity cost. Debt has no opportunity cost or is not applicable because you don't borrow only when there is no project, when there is no need. CAPM, the capital asset pricing method, which we use to compute cost of equity, relying upon risk-free rate, market rate, beta as a formula, is a framework. It is traditional, tested, age-old framework, very good framework. I do use it as frequently as possible, even for a smaller transaction and for the most complex transaction. However, it's not foolproof. Why? The market rate, the risk rate, and the beta are the variables where we can easily go wrong. Mostly we will go wrong. Therefore, it's not foolproof. It's a framework. Into the framework, how the variables will go, what quality does these variables hold is our responsibility as the applicant, as a finance leader. At the same time, in the CAPM, do not use your company's historical beta, which we generally do. Go with bottom-up beta from an unlevered company and delink it and then apply the leverage and then arrive at the bottom-up beta. It is application of bottom-up beta which is important for all companies which do not have historical data, which are changing their financing program, which means every additional dollar, rupee into the business will change the capital structure. When there is a change in the capital structure, historical beta is not applicable. Historical beta is not applicable, is inapplicable, which means you have to essentially also or mostly rely upon bottom-up beta, which is the market given beta from the references of comparable companies, unlevered comparable companies, apply your leverage and arrive at the bottom-up beta. It is that beta which will give you true cost of equity and therefore true cost of weighted average cost of capital at the company level. And finally, you will have a target capital structure. Can it be for today? Can it be for yesterday? Yesterday was dead, yesterday itself. Today is no more. It's passing. You have tomorrow and day after to set a target capital structure out of your learnings on your weighted average cost of capital. Therefore, there is profitability into your business and therefore your company will remain solvent in the days to come. Cost of capital is market linked. Now, this gives us a bit of entertainment come understanding. We are computing cost of capital for our company. What we are computing is not determined by us. We are only computing like a calculator, like a mechanical person doing the math. But it is determined, it is fixed by the market. We are taking variables from the market, putting into our equation, computing it only for our understanding. Market has already computed that cost of capital. This cost of capital is present in the market. Therefore, when you float your IPO, when you float your FIBO or a strategic sale or a preferred sale, investors negotiate a return. That return is cost of equity which they computed. When you borrow a bank loan, bank has fixed an interest rate on your debt program, on the debt amount. That is computed by the market, by the bank, or by the debenture holders, or by the bond holders and the likes. What are you doing then? Theoretically, it looks like we are computing cost of capital. We are determining cost of capital. We are computing, you're right. We are not determining. We are adopting the cost of capital on our company, which is fixed, which is worked out, which is determined by the market forces. We are just understanding what is the cost of capital on us and computing for our understanding to measure which projects can we take, which projects we can't take, and becoming knowledgeable about the result or about the outcome, the number, what is thrown from the market. We just need to collect it from the market and compute. We are only computing, not determining. This insightful equation, insightful fact is not known to all of the finance professionals. Most of us would know, but when you discuss with your colleagues, they would not know this fact. There is a lot of depth in it, insight in it, and a lot of theory underlying in it, which can be known, sensed only when we understand the insightful, deeper thoughts on this cost of capital, who is determining, what is the risk, etc. And by the way, to complete this statement, cost of capital is not for your past projects, is not for the equity and debt sitting in your balance sheet right now. It is for your future risk and future funding program, future growth, future activity. It's not for the past. We tend to keep some liquidity in the balance sheet, in the chest. It could be undrawn debt limit, working capital, cash credit, overdraft, or anything else, or mere bank money. It has a shadow cost. We tend to miss this in the big program of weighted average cost of capital. We ought to know that this shadow cost could be significant depending upon the volume of liquidity we always maintain. We have to maintain liquidity, otherwise we could become insolvent. That liquidity will have a shadow cost. Just that we need to be aware, be conscious about the liquidity and its cost, and factor this cost into our overall cost of debt, and then compute the realistic applicable WACC. Why all this discussion? Before I thank you for the opportunity and find the kind of good discussion, we need to understand cost of capital is a measure of investors' confidence. These investors could be financiers, equity or debt. It is their confidence, what is seen, reflected in the cost of capital of the company. If a company has lower cost of capital, implied that it is commanding higher confidence among its investors. If a company has higher cost of capital, implied clearly that its investors have lower confidence on that company. And this is just an overview, a quick brush of all the topics. These topics all put together as a pack will require at least 4.5, 5 hours masterclass workshop. We took only 10% of our time, 15% of that for a quick discussion for multiple reasons. One, just for us to understand what we need to learn, what we know, how do we refresh our knowledge, but then discussions in detail, couple of illustrations for realistic understanding and inference, and the full learning can be in a workshop where I will participate, few other professionals also will participate, and a team of 2-3 members will guide you in understanding all those things on a day when we fix as per our mutual convenience. And my sincere thanks for including me in the CFO Club, and my sincere thanks to the committee of CFO Club. My sincere thanks to all our colleagues and professional friends who participated in this discussion. Now we can have few minutes of Q&A. Should there be any queries to discuss?
Thank you, Dr. Kishore. Thank you very much.
Thank you, sir.
And thumbs up are coming for you.
Sir, thank you.
So that is nice to see. And let me see the chat box if there is any specific query, or
Please,
if anyone have posted any such specific thing on this.
kindly, sir.
As such, there is no specific query posted, but if anyone wants to uh, come online and ask a question or so, then definitely they are welcome. Otherwise, we have to wind up the session.
Yes, please, sir.
And before the people ask, let me put forward again.
Samir bhai, there is a question by Mike Barwani. Let me repeat. I think he's not
Sure.
around. Which external data source provider do you use or recommend to quantify different data point, risk, etc., by industry and country?
Kindly repeat the first part of the question, sir.
Which external data source provider do you use or recommend to quantify different data point, risk, etc., by industry and country level?
Okay, sir, there are multiple sources. There is no specific recommendation. Broadly, they have small variations. For example, for beta, all of us follow Ashwat ji. So it's like that. Or sometimes we take from the Morning Star, and any data is fine. But one important thing is data validation is our responsibility. Data validation is our responsibility. We'll have to just try to validate the data to the extent possible, and with the source what we quote in our workings, we'll have to complete
Noted.
our workings.
There is a post by Kunal L. Please share transcript on the group once done. So I believe couple people are using some software to capture the transcript of the call. So I request the member if they can email to the CFO Club ID. It will be shared with everyone via email as well. So I'm sharing the email ID of a CFO Club in the group, in the chat. So anybody who's capturing the transcript of the call, please share or email.
Hello, I am Anurag Chaudhary. I'm based in London. Can I ask a question?
Please,
Sure,
sir.
please go ahead.
See, I am right now working on solution and I'm actually implementing it in India for export factoring. And what I am facing are two fundamental issues. When you go to a corporate in uh, India and say, hey, I'll give you export factoring, it will be off your balance sheet. The first thing they go is, what's the price? And then they say, hey, my EPC export packing credit is at SOFR or Sonia or Euribor plus 100 basis point. You are at 300 basis point. I don't want you. So what is missing? Are they comparing price, or do they even are experienced enough to do or understand this, or should we be positioning this that they don't understand off balance sheet benefit, where if you go to Nestle in head office in over here, they will grab it in their cost of borrowing is 20 basis points or 5 basis points, but they pay even 500 depending on the counterparty risk to get it off their balance sheet. So open to an idea, Kishorji, to help us, because what, just to give you an idea, we are looking at how can I next year, our aim is to do about $3 to $5 billion, which is about more than 30,000
Almost
crores
30,000 crores Indian rupees.
exports from India, because I was a part of the initiative how to get India into international supply chain, and I'm trying to do it at competitive cost. But ये सबसे बड़ी problem आ रही है. So over to you.
Sir, thank you, sir. Thank you. It's so nice and privilege to listen from you with your London experience and then from the location. Now, sir, it is like this. Here in India, of course, we are broadly using SOFR. Sonia is also used. Euribor is rarely used. Within India, the interbank transactions and the transactions are happening on repo as a peg. These things aside, there could be any peg for us because LIBOR died about 3 years back, and we have been using SOFR and SONIA. Those things aside, now coming to the markup, the credit spread, what you spoke very insightfully, varies from country to country, firstly, then company to company. The reason is you already spoke one implicitly one good point, which in fact answers, which is the credit spread, the credit risk. India being BBB plus commands higher risk premium, and all companies within India will also carry on their shoulders this higher risk premium. Even if it is L&T, even if it is Reliance, even if it is Tata, Godrej, etc., each of them are also subjected to the higher risk premium because of their domicile in India. And how do some companies plan to not to avoid but to manage to address this issue? They have their subsidiaries or companies abroad which will involve in the financing program and will route that money into Indian entity in the form of the same equity or same debt with the same leg, same tenure matching. Therefore, while this also can come at a slightly higher cost than the first leg, it will be far lower if the same funding is mobilized within India. For example, as all of us know, most of the fund mobilizing subsidiaries are group arms, group entities have their HQ in the Raffles Place in Singapore, in Jurong, or around the Raffles Place, wherever, the capital circle, etc. Why do they have their subsidiaries there? Is so much of capital available in Singapore? No. But is capital within Singapore cheaper? No. It is as expensive or relatively lower expense than India, but not very, very cheap. Then why? The reason is these arms are domiciled in a country which carries very lower credit risk at the country level, and therefore the debt funding, the debt amounts to the company located in Singapore comes with a lower credit premium. And the enforcement loss there, the credit premium includes multiple factors in which enforcement strength is also one of the factor. So the enforcement loss being stronger there allow the investor to require to expect lower credit risk premium only. With these
Okay,
things,
I understand which way you're going, Kishorji. We should collaborate, but and have a separate discussion. But let me give you two things.
yes,
A, export तो इंडिया से हो रहा है ना,
yes, sir.
तो सिंगापुर एंटिटी का कोई फायदा नहीं. India is exporting. India, you have to get India into international supply chain, how to sell to Levi's, Gap, etc., IKEA, etc. Second is the subsidiary. I know I've talked to them. The problem is that the subsidiary people use that phrase, A, they're not exporting. B is that the subsidiary is obviously lower credit rated than the parent. So while they get away with the country risk, they don't get away with the credit rating of the individual legal entity. Then the head office has to give a parent guarantee, which is subject to English. So it comes back to India risk by default. The bankers look at it that way. Like you look, yeah.
Sir,
But
once,
anyway, हमें उस पे नहीं जाना सिंगापुर पे debt raising. I am saying exports from India. My exporter has to be based in India. It doesn't mean an overseas entity at all. उसको कैसे convince करें to pay the premium because they're getting extra dollars or whatever, and they're managing the counterparty risk, and how can we promote export? So Kishore ji, अगर किसी तरह से कुछ हो सके, I think the CFO Club will have my contact details. If you can, somehow connect two of us, we'd love to have a discussion. And हमारे अभी तो we are already executing 4,000 crores के exports from India.
sir,
हम किसी और कुछ कर सके तो बहुत अच्छा होगा. It helps the whole country as a whole. So I will pause with that and leave it for the others to ask their questions. Thank you.
thank you, sir. This is very deeper and insightful query, and There is
Yes,
a lot of depth
absolutely.
in
It was a
transaction.
deeper one. Rajesh bhai, if you don't have anything to say, then should we wind up the meeting?
Certainly, I will proceed with vote of thanks. Any member have any query, they can email to CFO community. That will be coordinated with Dr. Keshore, the speaker of the day. Friends, I think we are already passed through by 10 minutes to the scheduled time. So I'm moving to vote of thanks. I would like to thanks to Dr. Kishore for making to understand what is a cost of capital, CAPM model, hurdle rate, opportunity cost, and financial break-even. This is very crucial. It's a crucial to know what is historical and what is the perspective
जो
going
फोन
forward.
मुझे भेज
As board, we can have the cost of capital, which need to be versatile, which should be we should be able to calculate very fast, which should be agile. More importantly, we cannot make presumption about the risk across the business. Thank you, Dr. Keshoreji, for sharing your experience and making deep dive into the cost of capital. The complex topic into very lucid and simple manner. Of course, the calculations are always complex and deeply complex. And looking forward to your masterclass. I'm
Yeah.
sure everybody have got benefited out of it. With this note, I would like to thank one again to Dr. Kishori and every member present here for making this interaction very meaningful and for their valuable time.
Yes, and so far as dates for masterclass are concerned, soon they will be shared. Thank you everyone for patience hearing, and once again thank you to Dr. Kishore.
Thank you, sir. Thank you, sir.
Good
Thank
day
you.
to everyone.
Thank you, sir. Thank you, sir. Thank you, please.